everybody thinks it's gold rising, but actually it's fiat currencies declining. And I'm trying to ram that message home because the people who will protect themselves from the multiple crises that are now in view, they're the people who actually understand that it's the paper currencies going down, not gold rising. And it's really for that reason that, when people ask me, what's your target for gold or silver, I don't give one. I mean, as a long-standing stockbroker, I know that every forecast you make is just something that you pluck out of thin air. No point in doing it. Silly game. So I don't do that. But also, the question should be phrased, how far do you see the dollar going down or euro going down or whatever your favorite currency is? And the answer to that, I'm afraid, is I think they're all on their way to zero. The question is, how long will it take to get there? That depends, I think, on how events unfold. I mean, we've got potential war in the Ukraine and also in the Middle East, which could end up with being nuclear. Obviously, it's goodbye everybody if we go down that route. But there is also the fact that the US dollar is in a debt trap, and there seems to be absolutely no recognition in the political class of the importance of that position, and they're still spending like Billio. The excuse is, and it's an election year, and we've got to get re-elected. And on top of that, I mean, we've drifted into socialism in Europe with France and now the UK. That's going to bring on financial disasters for both the euro and also sterling. And you can see that the Bank of Japan is suppressing interest rates at the zero bound. They're still zero. They're determined not to raise them. At some stage, they're going to have to do it. But I think the biggest problem, which everybody is getting wrong, and I mean virtually everybody, is the outlook on interest rates. They think that interest rates are going to fall. They're not. I mean, they might come down a touch because central banks actually don't understand the role of interest rates, and also they're under huge pressure from markets to reduce interest rates. Also, they're under pressure to, if you like, alleviate the problems in the banking system, which undoubtedly are exacerbated by current interest rates. I mean, look at the commercial real estate situation in America, for example. You've got zombie companies who cannot afford interest rates at this level, and they're gradually having to refinance themselves from the lower rates to which they became used. These are all disasters coming up, and I don't know which one's going to hit the fan first. I mean, nobody does. But it's all there. It is all there, and that will give you your timing.
Everyone seems to think gold is rising, but Alasdair Macleod argues that what we're witnessing is a decline in fiat currencies. This distinction is crucial. When we see gold prices increasing, it's not that gold itself is becoming more valuable, but that the purchasing power of currencies like the US dollar, euro, and yen is diminishing. To drive this point home, consider this. If the paper currency is losing value, the nominal price of gold will naturally rise. This phenomenon isn't about gold gaining, but about currencies losing. The real value of gold remains constant. It is the yardstick by which we measure the true worth of our money. Alasdair highlights the precarious situation the US dollar finds itself in. It's caught in a debt trap. The political class appears oblivious to the long-term implications of excessive spending and mounting debt. This debt trap is a major reason why fiat currencies are on a downward spiral. Inflation is another factor eroding the value of paper currencies. With central banks around the world printing money at unprecedented rates, the purchasing power of these currencies is steadily declining. Gold, on the other hand, has been a store of value for millennia, maintaining its purchasing power through various economic cycles. Many people believe that interest rates will fall, but Alasdair challenges this assumption. Central banks, under pressure from markets and political forces, may attempt to lower rates temporarily. However, they fundamentally misunderstand the role of interest rates. High interest rates are necessary to curb inflation, yet the pressure to keep them low is immense, exacerbating economic instability. Consider the commercial real estate situation in America. Zombie companies, which are barely surviving due to low interest rates, will face significant challenges as rates rise. These companies cannot afford the current interest rates, and refinancing will be a disaster, leading to widespread financial turmoil. Geopolitical factors also play a critical role in the value of fiat currencies. Potential conflicts in Ukraine and the Middle East could have catastrophic consequences, including nuclear escalation. Such scenarios would significantly impact global markets and the value of currencies. Moreover, the geopolitical landscape is shifting against the US dollar. Countries like China and Russia are actively reducing their dollar holdings and increasing their gold reserves. This shift is partly due to the declining trust in the dollar's future value and the broader geopolitical strategy to reduce dependence on the US-dominated financial system. Central banks, particularly in Asia, have been accumulating gold for years. The People's Bank of China has been systematically reducing its dollar reserves and increasing its gold holdings. This strategy aligns with their long-term view of a declining dollar and the potential shift towards a gold standard. India, traditionally Keynesian in its economic approach, has also started accumulating gold. As a member of the Shanghai Cooperation Organization, India is privy to discussions about the future of the global financial system, which increasingly points towards a gold-backed framework. Alasdair provides a historical perspective on gold accumulation, particularly focusing on China. Since the 1980s, China has been methodically building its gold reserves. The People's Bank of China has handled all foreign exchange transactions, ensuring a significant portion of their reserves is in gold. If we consider the traditional wisdom that 10 to 15% of wealth should be in gold, the scale of gold accumulation by China is staggering. This strategy is a hedge against the declining value of fiat currencies and a preparation for a potential future where gold plays a more central role in the global financial system. In conclusion, Alasdair Macleod's analysis reveals that the perceived rise in gold prices is a reflection of the declining value of fiat currencies. The debt trap, inflation, and geopolitical tensions are all contributing to this decline. Central banks, particularly in Asia, are preparing for this shift by accumulating gold. Understanding this dynamic is crucial for anyone looking to protect their wealth in these uncertain times. Stay tuned for part 2, where we dive deeper into the implications of these trends and what they mean for the future of gold and silver investments. Don't forget to like, subscribe, and hit the notification bell to stay updated with our latest insights.
People's Bank of China has been buying gold, but actually it hasn't been buying gold, it's been selling dollars. It's been reducing its dollar commitment. Now, as to whether it's frightened about the future value of the dollar, or whether it is merely in line with the Communist Party's meme of reducing the involvement of the dollar, you can pick either of those reasons. When we look at the other central banks, predominantly in Asia, who have been accumulating gold, again, I think there are these twin reasons. They can see that the geopolitics is actually working against the dollar, so the dollar's value is likely to decline on that basis alone over time. Furthermore, they can see, they will know, they have the inside track. They have these sort of quiet meetings to which we are not privy amongst the monetary panjandrums, if you like, in the Asian central banks, knowing that they're moving towards a gold standard. It's probably some way off, but obviously you need to accumulate some gold. Now, India is very interesting in this because India has denied gold. India has been Keynesian in its approach to economic management. And I think that also includes, sort of a sort of semi-official view that gold is a pet rock. But that has now changed. The government is now accumulating gold. Why? Because they're a member of the Shanghai Cooperation Organization. They're privy to the conversations, and they know that that's the direction in which it's going. They don't want to be first going there, but they know that they would be complete idiots not to accumulate some gold, even if they hope the problem will go away. So that, I think, is what's happening at the central bank level. Now, at the market level, we have seen for well over a decade now that the Chinese in particular have been stripping gold out of Western vaults, out of Western mines, whatever. They have been accumulating gold. I have a copy of, in English, of the original articles appointing the People's Bank of China to act for the Chinese nation in the accumulation of gold and silver. And that was dated in 1983. Now, since then, there's been massive investment inflows and through the 80s and in the 90s, massive growing and through into the 2000s as well and beyond, growing export surpluses. Now, all the foreign exchange transactions are handled by the same organization, the People's Bank of China. So all those flows go across their desk. Now, if you're old enough to remember how central banks, how conservative individuals, non-speculating individuals, those who wanted to protect their wealth for the long term, how they looked at gold, and this would include the Chinese, they reckoned that you should have somewhere between 10 and 15% of your money in gold, and the rest is credit for you to do whatever, buy houses, buy expensive yachts or whatever. That's the Arab approach. If you just take that 10% and you look at the cross-border flows, firstly the big capital inflows in the 80s, and then the growing surpluses with continuing inflows, the amount of stuff crossing the PBOC's desk, you take 10% of that at contemporary prices. And remember, this was a bear market that took the gold price down to $250 in 2002. I reckon that was over 20,000 tons. That's a substantial amount of gold. The largest, in fact, of anywhere in the world.
Alasdair Macleod's assertion that fiat currencies are on their way to zero is a bold statement, but it is backed by compelling evidence. The relentless printing of money by central banks and the mounting national debts create an unsustainable financial environment. As currencies devalue, the intrinsic value of gold and silver becomes more apparent. Gold and silver have historically been safe havens during times of economic turmoil. Unlike fiat currencies, which can be printed at will, the supply of gold and silver is limited. This scarcity, combined with their intrinsic value, makes them reliable stores of wealth. When fiat currencies lose value, gold and silver retain their purchasing power. For example, during the 1970s, the U.S. experienced high inflation, and gold prices soared. Similarly, in the aftermath of the 2008 financial crisis, gold prices rose significantly as investors sought safety. Central banks around the world are accumulating gold as a strategic move. The People's Bank of China, for instance, has been buying gold not just to diversify its reserves, but also to reduce its reliance on the US dollar. This trend is evident across many Asian central banks. These banks understand the long-term implications of a declining dollar. By holding gold, they are hedging against future economic uncertainties and potential shifts in the global financial system. While it may seem far-fetched, there is growing speculation about a potential shift towards a gold standard. This would involve countries backing their currencies with gold, providing a stable and reliable measure of value. Such a move would require significant gold reserves, explaining why central banks are stockpiling gold. The geopolitical landscape supports this theory. Countries like China and Russia are keen to reduce their dependence on the US dollar. A gold-backed currency could provide an alternative to the current dollar-dominated system. For individual investors, understanding these trends is crucial. Investing in gold and silver can provide a hedge against inflation and currency devaluation. Here are some key considerations for potential investors. 1. Physical gold and silver. Investing in physical gold and silver, such as coins and bars, is a direct way to own these precious metals. This approach provides tangible assets that are not subject to the same risks as financial instruments. 2. Exchange-traded funds, ETFs. Gold and silver ETFs offer a convenient way to invest in these metals without the need for physical storage. These funds track the price of gold and silver, providing investors with exposure to price movements. 3. Mining stocks. Investing in mining companies can offer leveraged exposure to gold and silver prices. However, this approach comes with additional risks, such as operational and geopolitical factors affecting the mining industry. 4. Diversification. Diversification is key to managing risk. While gold and silver can be valuable components of a portfolio, it's essential to balance them with other asset classes to mitigate potential losses. Geopolitical tensions, such as potential conflicts in Ukraine and the Middle East, can have significant impacts on global markets. These tensions often lead to increased demand for safe haven assets like gold and silver. For instance, during the Gulf War and the Iraq War, gold prices surged as investors sought refuge from market volatility. Similarly, current tensions in Eastern Europe and the Middle East could drive gold prices higher as uncertainty looms. Contrary to popular belief, Alasdair Macleod argues that interest rates are unlikely to fall significantly. Central banks are under immense pressure to address inflation and economic instability. High interest rates, while challenging for the economy, are necessary to stabilize markets. Investors should be prepared for a prolonged period of higher interest rates. This environment will be challenging for traditional investments, but beneficial for gold and silver, as they typically perform well during times of economic stress. China and India, two of the world's largest economies, play a crucial role in the gold market. China's strategic accumulation of gold aligns with its long-term economic goals, while India, despite its Keynesian approach, has recognized the importance of gold as a financial asset. These countries are not just major consumers of gold. They are also significant players in shaping the future of the gold market. Their policies and market activities will continue to influence global gold prices. Alasdair Macleod's analysis provides valuable insights into the true value of gold and silver. As fiat currencies decline, the importance of these precious metals becomes more evident. Central banks are strategically accumulating gold, and geopolitical tensions further underscore the need for safe haven assets. For individual investors, understanding these trends is crucial. Gold and silver offer reliable protection against economic instability and inflation. By considering physical assets, ETFs, mining stocks, and diversification, investors can navigate the uncertain financial landscape. Thank you for joining us in this comprehensive discussion on the value of gold and silver. Don't forget to like, subscribe, and hit the notification bell to stay updated with our latest insights. Until next time, stay informed and stay invested in your financial future.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.